In January 1980, silver briefly spiked to $50 per ounce, equivalent to over $200 in today's dollars, triggering the most infamous market corner attempt in modern history. Brothers Nelson Bunker and Herbert Hunt, heirs to an oil fortune, spent billions buying physical silver and futures contracts, betting that inflation and scarcity would send prices into the stratosphere. For a moment, they succeeded. But then the system fought back. The COMEX changed margin rules overnight. Brokers demanded impossible collateral. Banks refused to lend. Within weeks, the Hunts were bankrupt and silver crashed by 80%. It was a textbook case of speculative excess meeting institutional resistance. Now, in early 2026, silver has surged past $92 per ounce, an all-time nominal high, and whispers of Hunt Brothers 2.0 are returning. Yet this time, something is different. There are no lone billionaires cornering the market, no secret syndicates hoarding vaults. Instead, the pressure is coming from structural forces, a real physical deficit, record industrial demand, central bank accumulation, and vanishing exchange inventories. This isn't a speculative bubble. It's a supply shock wearing a bubble's disguise. By the end of this video, you'll understand exactly how the 1980 episode unfolded, why today's drivers are fundamentally different, and what this means for whether silver can sustain triple-digit prices or collapse just as suddenly as it did 46 years ago. To grasp the scale of the Hunt brothers' gamble, we must revisit the mechanics of their scheme. In the late 1970s, inflation was running at 13%, gold was breaking records, and confidence in the dollar was crumbling. The Hunts believed silver, a monetary metal with industrial utility, was undervalued and poised to explode. They began accumulating physical silver in 1973, eventually holding over 200 million ounces, nearly 7% of all above-ground silver at the time. But their real leverage came through futures. By 1979, they controlled over 50% of all long positions on COMEX, often using borrowed money and complex cross-margin agreements. Their strategy relied on two assumptions. First, that physical demand would outstrip supply. Second, that the financial system would allow them to keep rolling their positions indefinitely. For a while, it worked. Silver rose from $6 in 1979 to $50 in January 1980. But then regulators intervened. On January 7, 1980, the COMEX introduced liquid-only trading, banning new long positions. Margin requirements were doubled overnight. Simultaneously, the Federal Reserve tightened credit, making it harder for brokers to finance leveraged bets. The Hunts couldn't meet margin calls. Forced liquidations triggered a cascade. By March, silver had fallen to $10. The brothers lost over $1 billion, equivalent to $4 billion today, and were later sued for market manipulation. The lesson was clear: no individual, no matter how wealthy, could defy the combined power of exchanges, regulators, and the banking system. Today's rally looks superficially similar, but the anatomy is entirely different. There is no single entity controlling the market. According to CFTC data, the largest four traders hold just 28% of COMEX net long positions in early 2026, down from 50% in 1980. Physical accumulation isn't concentrated in private vaults but distributed across central banks, industrial users, and retail investors. China's central bank and state agencies have quietly added over 65 million ounces since 2022, per customs data. India's government holds another 50 million. Retail demand in the US, Germany, and Turkey has pushed global coin and bar sales to record highs, over 300 million ounces annually. Meanwhile, industrial consumption has surged to 620 million ounces in 2025, Silver Institute, driven by solar panels, EVs, and 5G infrastructure. This isn't speculation, it's real demand meeting constrained supply, and supply is indeed constrained. Global mine production peaked at 880 million ounces in 2024, USGS, and is now declining due to water shortages in Peru and Mexico, aging mines in Australia, and permitting delays in new projects. Recycling, once a key buffer, has plateaued at 180 million ounces as recovery rates from electronics remain below 20%. The result? A A structural deficit of over 150 million ounces in 2025, covered only by drawing down exchange inventories. And those inventories are vanishing. COMEX registered stocks fell to 26 million ounces in January 2026, the lowest since 2018 and equivalent to less than 3 months of industrial demand. London good delivery bar holdings outside China stand at a 12-year low. In such a tight market, even modest buying pressure can trigger sharp price reactions, not because of manipulation, but because there's simply no spare metal to absorb demand. This is the critical difference. 1980 was a liquidity crisis caused by leverage. 2026 is a physical shortage caused by fundamentals. The hunts failed because they ran out of credit. Today's buyers aren't relying on margin. They're paying cash for metal that's disappearing from vaults. When JP Morgan takes delivery of 10 million ounces, or when a Chinese solar manufacturer signs a multi-year offtake agreement with Fresnillo, they're not speculating. They're securing inputs for real production. This shifts the risk profile. In 1980, the crash was triggered by forced selling. Today, the risk is a physical delivery squeeze. If COMEX shorts can't source metal to settle contracts, prices could spike far beyond $100, not due to greed, but due to scarcity. Another key distinction is the role of policy. In 1980, regulators acted swiftly to crush speculation. Today, central banks are part of the buying pressure. The People's Bank of China, Russia's central bank, and Turkey's CBRT have all added silver to strategic reserves, viewing it as both a monetary hedge and an industrial safeguard. Even the U.S. Defense Department lists silver as a critical material under the Defense Production Act, stockpiling it for radar, satellites, and missile guidance systems. This isn't rogue speculation, it's state-level strategy. And unlike 1980, when the Fed was fighting inflation with high rates, today's environment is more ambiguous. After cutting rates in late 2025 to support growth, the Fed has signaled a higher-for-longer stance only if services inflation reignites. This creates room for hard assets to thrive, especially when fiat credibility is questioned. Moreover, the financial architecture has changed. In 1980, futures dominated price discovery. Today, physical markets exert greater influence. Over 70% of silver trades OTC, over-the-counter, between miners, refiners, and industrial users, outside exchange oversight. ETFs like SLV have bled 120 million ounces since 2021, but that metal didn't vanish. It moved into private hands, sovereign vaults, and factory supply chains. This fragmentation makes the market less transparent, but more resilient to exchange-driven crashes. You can change COMEX rules, but you can't force a German solar plant to stop using silver. Could silver hit $100 or beyond? The path is narrower than in 1980, but more credible. If mine supply continues to fall, if clean energy mandates accelerate, and if central banks keep buying, $100 becomes not a speculative fantasy, but a market-clearing price, the level needed to ration scarce metal among competing users. Solar farms may delay expansions. Automakers may accelerate copper plating R&D. But in the short term, someone will pay the price. And unlike 1980, there's no easy off switch. Regulators can't ban industrial demand. Exchanges can't create physical silver. The only solution is higher prices or lower consumption. For ordinary investors, the lesson is caution without panic. The Hunt episode teaches us that leverage kills, even in strong markets. But the 2026 reality teaches us that scarcity matters more than sentiment. If you hold physical silver, you're exposed to volatility, but also to a genuine supply crunch. If you trade futures, you face margin risk in a thin market. Either way, this is a 1980 redux. It's a new chapter in silver's dual life. As both an industrial workhorse and a silent store of value, the ghost of the Hunt brothers still haunts the market. But today, the real story isn't about two men trying to corner silver. It's about the entire world realizing how little of it is left and how badly everyone needs it. That if you want clear, fact-based analysis of silver's role in technology, finance, and national security, without hype, fear, or conspiracy, subscribe to US Silver Market. We track the real flows behind the headlines, because in a world of hidden shortages, truth is your strongest asset.